We're really running up on an inflection point in the economic cycle. A lot of stuff is going on here that looks to be creating headwinds, or at least the potential for real change in the nature of our expansion, right smack dab in the middle of the next biennium. Somewhere in the 2020 range. We're seeing a lot of things build up, and we're looking at an inflection point, or a potential one at least, in economic growth. And these are always really the things that are so difficult for economic forecasters to get a hold of, is when times are changing, and we've really struggled with that over the last couple of decades. Sometimes we can see these imbalances, or we can see the headwinds like we do now, but it's hard to really put them, operationalize them into a planning forecast that's reasonable. In the 90s, we certainly saw that stock markets were overvalued for tech stocks and the like during the tech boom, and our chairman of the Federal Reserve was talking about irrational exuberance, in the middle of the decade, and was concerned about these imbalances building up, and this was well known across all economists. But that said, then as we went deeper into the 90s, everyone's making money. Our buddies are going out and day trading during the day and making a killing, while the smart people who are saying to make the long play, and the economic forecasters are too pessimistic, are always wrong. It's just a matter of degree. It seems like everything is really landing here in this mid-2020 period. In terms of the fiscal side of things, we know the tax cuts now, from an accounting perspective, the federal tax cuts are turning away from a boost and into a headwind as we cut taxes less going forward, and then eventually get rid of them in 2025.
Our food manufacturing, our food processing here in the Valley, right, where all these industries are importing something, and so to the extent that the simmering trade issues continue to escalate and broaden across a wider range of products, include more countries and things like that, then that's where we could potentially see a true economic issue, where you kind of muck up these global supply chains, and so they would impact everybody, and it increase costs, it increase transportation costs. You have to rejigger the supply chains and things like that. Wood products, some of the metals, a lot of that stuff is maybe a little less reliant on imports and exports relative to things like transportation equipment with airlines and some automobiles and things like that. But the thing with food and beverage and timber in particular is we're using local things, right? We're using locally grown hops, we're using locally grown trees, and then turning those into value-added products that we then ship worldwide at the same time. So everything has some degree of exposure to imports and exports, but beyond just the growth accounting perspective and maybe some of these impacted industries, another factor with the tariffs are price increases, right? If we're putting 10, 25% tariffs on products, that's going to raise the price to consumers, and but the biggest thing is it'll be extremely challenging, and everyone's talking about the Federal Reserve being the key determinant in determining where this expansion tends to end and where the next recession will begin. And the biggest challenge here would be these ongoing subdued growth expectations for the U.S. economy. And so things that impact long-term growth, overall rate of inflation for just average or nominal income growth, nominal GDP growth, inflation expectations are anchored around 2%. People expect inflation to be around 2% moving forward. Demographics, when it comes to real GDP growth or real economic growth, is about how many people are working and how productive they are, right? And we know the number of people working as a share of the economy and the increases will be a lot slower moving forward due to the demographics. Even as the baby boomers are aging out of their working years and into retirement years, there are plenty of millennials and Gen Zs, or whatever you want to call them, replacing them. But those net growth rates are lower because of the flows being so much larger. So you can see here the bottom line, the labor force line, right? We're seeing very, very low rates of labor force growth and employment growth relative to the past because of the demographic churn or the demographic shift. But overall, the U.S. has very slow labor force growth due to the demographics. The wild card here, and the one that potentially will raise long-term growth expectations to a larger degree, would be productivity. The amount, how much output per hour worked is the general measure that economists prefer. That's been growing at almost historic low rates for the last 5 years. It's expected to rebound a little bit moving forward, but not a ton. And a lot of this is just kind of mean reversion in these economic forecasts. This is productivity is the least well understood indicator you see on this chart in front of you, and people are furiously trying to figure out what drives productivity to a larger degree. There's some encouraging signs. Business investment starting to pick up. R&D spending as a share of the economy recently hit an all-time high. It's all private sector spending. The public sector continues to pull back, particularly at the federal level in terms of R&D spending, but the private sector continues to put money in. But it's not just whether you're spending money on R&D to come up with new products and services. It's the success of that, right? So you got to put the money up and then put the time and the investments into it, and then hopefully that comes to the fruition and you get some sort of new innovations and increased efficiencies and things like that moving forward. So there's a chance productivity will pick up, and if it picks up substantially, that'll make the Federal Reserve's policy a lot more room to navigate, a lot more room to operate. They're starting to get there at the U.S. level. U.S. wages are picking up. They're in the 2.7, 2.9% annual range at this point. They're slowly accelerating. Well, in Oregon, we've already been there, and some new research from our friends over at the Employment Department confirmed that if you look at median hourly wages, so the data we tend to look at, you can compute average wages, total wages and total employment, and you divide them. Well, they're looking at the individual records for workers in Oregon. Median hourly wages in Oregon have been just over 3% for the last 3 years, right? So at the U.S., we're just now getting to 3% wage growth. Well, in Oregon, we've been at 3% for the typical worker for the last 3 to 4 years. So again, we're seeing better gains here, but still kind of on par with inflation and productivity. So you're right. To the extent that productivity increases, we'd expect to see wages strengthen further.